Joining me now is Michael Faulkender. He's former Assistant Treasury Secretary for Economic Policy, Chief Economist at AFPI, and Economics Professor at the great University of Maryland. Good to see you in person. Thank you for being here.
Great to be with you.
We'll talk about the revisions in a second. First of all, that the acting labor secretary, she had kind of a checkered record out in California, didn't she?
She did. She led the labor office in California during the pandemic, where we had all of that unemployment insurance fraud.
Yes, indeed. Well, let's talk about oil if we can. We talked about it a little bit yesterday. Today, it was up again, well over $85 a barrel. In fact, very close to $86 a barrel. Despite all of the talk from the administration about inflation coming down, even though prices have not come down, I see a new push for inflation in these energy numbers. Am I wrong?
You're not wrong. That's right. So both the CPI number and the PCE price index number, the one the Fed mostly watches, those are stale. Those are back from the July timeframe. So they're not going to yet include the increase in oil prices and the commensurate increase in gas prices, which means that 3.3 number that people were kind of exhaling about when they saw that it was a reasonably low number and the monthly number was only in the 0.2% range, that precedes the run-up in oil prices that's now started. And as we have talked about on many occasions, oil prices permeate all parts of the economy because it's not just the direct usage, but its energy is used to manufacture products, fossil fuels, to deliver products.
Food products. They're used on the farms. They're used in plastics. I mean, there's all kinds of rollover effects of increase in energy. So what we might see is an uptick in inflation like we haven't seen since when it went up about a year and a half ago.
That's right. And even if you look at the core number, because it permeates so much of the economy, even if you take out the direct cost of oil and gas by looking at the core inflation number, it's still going to be there because of all the manufacturing transportation costs that oil permeates throughout.
Now, Powell knows this, and the Fed members know this, right? So is this one reason why they haven't been sort of jumping on the it's time to end the rate hike bandwagon?
I think the reason they haven't been ending the rate hike is because Powell knows that his legacy is entirely defined on inflation. And the fact that he was the Fed chairman that saw 40-year high inflation means that he's going to focus entirely on getting it back to that 2% number, irrespective of whether or not it puts this economy into a recession.
All right, the revision on the jobs numbers. You're willing to cut the administration a little bit of a break there, aren't you? Because there are some pandemic issues that have to do with these revisions.
There are. So if you look at the data, there's the raw data and then there's the seasonal adjusted data. And we primarily look at the seasonal adjustments. And it's all coming in the seasonal adjustments that we're seeing these revisions constantly be downward after the initial number comes out.
Take a look at that. Can you put that back up on the screen there, those revision numbers? Because they are pretty dramatic. I mean, the initial report, 200,000. The first revision down to 185. This is the second revision down to 105. I mean, they're having some problems adjusting for these pandemic problems.
They are, because the data was so all over the place during the pandemic that the models are having difficulty with that. But for that reason, that's why I think that this was a pretty disappointing jobs report, because it really does mean you had a net 77,000 jobs. You only had wage growth of 0.2%, which means it's likely not going to keep up with the inflation that's likely going to come out for the month of August. And so overall, it seems to suggest that we are slowing down. Now, maybe that's what the Fed wants, because the Fed does continue to believe that the way that you contain inflation is by slowing down economic activity.
The old Phillips curve.
Exactly. But this is not a jobs report that if I were back in Treasury, I would have been happy with.
Yeah. All right. Let's talk about Bidenomics, which the president is having a great deal of difficulty convincing Americans is actually working for him. I mean, he whispers it's working, and Americans just know it's not. Is there any way they can put lipstick on that pig?
No, because the American people saw the 40-year high inflation that they suffered from that exactly resulted from the very first piece of legislation that Biden had enacted when he came into office, which was the American Rescue Plan. And ever since then, we saw the increase in prices at energy, at food, at every part of America's budgets, and wages have not kept up. And so What's ironic is for Biden to then come out with what I think he touts as his most successful piece of legislation, the Inflation Reduction Act, which merely serves to remind the American people that he caused inflation. So to root your major economic plan, call it Bidenomics, and remind people of all the inflation that you created during your tenure, I just don't think is going to be a good thing for them.
Quickly, on the other hand, have Republicans done enough in creating a coherent policy that they could sell to the public for the 2024 elections?
The number one thing that House Republicans did is pass H.R. 1, which is an Unleash American Energy bill. When you hear the Republican presidential candidates out there, they lead with energy production and all of the above energy strategy. And if we can get energy prices back down and have that permeate the economy while simultaneously taking away all of this excessive regulation, take tax increases off the table,
right,
cut back on the spending, and all of those things combined, I think, are a pretty good message coming into next year.
Michael Faulkender, great to see you in person. Thanks for being here. Appreciate it.